because I think it's their plan at some point to revalue gold. And it's obviously much better if you have it on your shore or in your control as opposed to overseas. I view it as what they did was they onshored unencumbered collateral because there's so little collateral left anywhere in the world to borrow against. And if they're going to revalue gold, they want it onshore so that collateral gets revalued higher here. Let me just repeat this for about the millionth time. The system, the real economy, forget about the financial system. We know that runs on credit. The real economy runs on credit.
Gold prices held steady early Wednesday, despite the strengthening U.S. dollar's impact on the market. Traditionally, a rising dollar has made gold less attractive to foreign investors. However, uncertainty in Washington has provided a counterweight. According to Bill Holter, the precious metal remains a vital hedge when trust in institutions begins to fracture, and current events are reinforcing that role. The standoff between President Donald Trump and the Federal Reserve has unsettled markets, particularly after Trump announced his decision to remove Fed Governor Lisa Cook due to allegations of mortgage fraud. This challenge to the Fed's independence has heightened concerns that political influence could distort monetary policy at a time when investors are seeking clarity on future interest rate decisions. Despite the stronger dollar, gold continues to benefit from its safe haven appeal, especially as investors anticipate the Fed may be forced into aggressive rate cuts. December gold futures settled 0.5% higher on Tuesday at $3,433 an ounce, with prices steadily advancing in recent weeks. After a modest retreat earlier this summer, bullion is now up more than 30% for the year, building on its strongest annual performance since 2010. Holter emphasizes that this resilience highlights gold's enduring credibility in times of policy turmoil, especially when monetary authorities appear caught between political pressure and economic realities. The Fed itself has noted that long tenures and removal protections for governors are meant to safeguard the integrity of monetary policy, underscoring the unusual and controversial nature of Trump's move against Cook. Looking forward, investors are bracing for a series of key economic reports, including U.S. GDP figures, jobless claims, and the Fed's preferred inflation gauge. With over 88% of market participants betting on a rate cut next month, expectations are building that Powell and the Fed will pivot despite lingering inflation concerns tied to trade and tariff policies. Holter warns that this daisy chain of collapse between politics, debt, and central banking may only accelerate demand for gold as a store of value. In his view, the unfolding battle over the Fed's independence and policy direction is not just about rate cuts, but about maintaining confidence in a system already under strain. If that confidence erodes further, he argues, gold's role will shift from being an alternative asset to a necessary anchor of stability in a volatile financial landscape. Now, we present the clips from Bill Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I would say go look in the mirror. You did it. I mean, maybe not him personally over just the last few years, but it's the system itself. And think about this. And one thing I pulled off from that is he's talking about the economy's growing at 1.2%. What's the growth rate of Treasury debt? What is the number? I'm guessing it grows at what, 7% plus per year?
Didn't they hit over $1 trillion in the most recent quarter?
Well, yeah, they're over $1 trillion on interest paid. And I think for the quarter, it was $1 trillion because the first quarter or the quarter prior to that, they borrowed way less than they had anticipated and then jammed it all in the first week or 2 weeks of the next quarter. But my point being, if you've got debt rising so much more rapidly than you do the economy, the real economy, to support the debt, to support the cash flow and thus the interest payments. It just seems to me that that's a mathematical equation. You can't do that. And we've known this for years that, any household that operated like the Treasury would be either bankrupt or in jail. So I think you need to ask yourself the question, if we're running a deficit of $2 trillion per year, on an economy. What's the size of the economy now? Close to 30 trillion.
Yeah.
That's 6-7% deficit per year. What would the economy do, or what would it have done if it wasn't for that additional spending of the 2 trillion that was borrowed by the Treasury? What would the economy have looked like over the last 10, 20, 30, up to call it 60 years or 60 plus years? Because we've deficit spent every single year. I mean, back in the old days, when I say the old days, I'm talking about the 40s, 50s, 60s. It
Wow.
was, oh, that's like ancient days for you, Chris.
You're around in the 40s, Bill? Goodness. Is that the
No,
1840s or?
deficits were supposed to be used during bad times to goose the economy. And then we were supposed to run a surplus during good times to save up for the hard times. Well, for 60 plus years, it's been nothing but deficit spending. And I would ask you, what would the economy look like had there not been any deficit spending?
So are you suggesting that borrowing $100 to make 50 is not the ideal structural arrangement?
Right.
Okay.
But you're absolutely right, but that is the structural arrangement. Well, you're exactly right. If he's talking about cutting rates, but inflation could be a problem, I mean, it's what the market's already told them a year ago when market rates went higher and after they cut interest rates. I suspect that's going to happen again. I think we're going to have a weak bond market in this cutting cycle, and it's math. I mean, if I was there, if I was a journalist asking questions, I mean, there's so many questions you could ask him, but the biggest one of all isn't inflation a result of monetary policy?
I don't think he believes that, or at least.
Inflation is a monetary event. Now, one thing he said was a one-time price increase. The only two things that could come to mind would be all of a sudden stuff costs more because of tariffs, or is he talking about a reset? Is that what he's talking about? I don't really follow what he's talking about, a one-time, right? There is none. And one thing you'll never hear a Fed chairman talk about is they constantly talk about CPI, PPI, because those are the government figures. I would say all you need to do is look at markets themselves, and there's your inflation. I mean, you've got inflated equity markets all over the world. You have interest rates way below what would be considered normal historically, going back hundreds of years. The low interest rates are inflation, if you will, in the pricing of bonds, because there's so much capital out there trying to find a home. So there's your inflation. I mean, yeah, it sucks when you go to the grocery store and stuff costs more, or gasoline costs more, or you're paying somebody more to cut your lawn or do work or whatever. Yeah, that's one form of inflation. But the one form of inflation they'll never tell you about or talk about is inflation in asset pricing. They call that a bull market. That's good inflation. Yeah, it's a two-tiered market. I can tell you firsthand, North American demand is way down. There's a ton of sellers, and the reason people are selling is because they're out of money. I mean, I'll bet you I've done 100 sales so far this year where people are cashing out. I've had, I don't know, 4, 5, 6 saying I'm buying real estate with it. But 85, 90% of the people that are selling say, I got to raise cash. I'm out of cash. Now, that's the retail side of it. And there's plenty of supply. I mean, any type of product you want to buy, there's availability, and the premiums are as low as I've seen in 15 years. Now, the other market, the institutional market, that has been red hot and on fire. You can see it with COMEX deliveries. You can see it with LBMA inventories. The inventories, the official inventories have collapsed. So with huge demand and collapsed inventories, it's only a matter of time before there is a failure to deliver. And if there is a failure, or when there's a failure to deliver, if we are still on a fiat system, everything burns down, because A failure to deliver breaks confidence. And this entire episode is one huge con, as in confidence game. Confidence will break.
So the big boys and big women out there, the money,
They're buying gold.
are buying this stuff hand over fist.
Yes, they are. They're
But
buying gold and silver. India is a big importer of silver, and it's interesting that the price of silver right now in China is almost 10% higher than it is in London and New York. Why is that? And that's only going to create an arbitrage that speeds up the process of failure to deliver, because they'll buy cheap Western gold and silver and they'll sell it in China.
Recent developments in U.S. monetary policy and debt management are drawing sharp attention from analysts who warn that the global financial system is nearing a critical juncture. The Federal Reserve faces mounting pressure as deficits expand and foreign appetite for U.S. Treasuries continues to decline, raising concerns about long-term stability in the bond market. With inflation proving more persistent than expected and government borrowing at record levels, doubts are growing about whether the dollar can maintain its central role without eroding confidence further. These strains are not isolated. They reflect a deeper fragility in a system built on leverage, where even small shifts in sentiment or liquidity can produce outsized consequences across global markets. Bill Holter emphasizes that this fragility has created what he calls a daisy chain of collapse, where debt obligations and credit structures are so interconnected that the failure of one link could rapidly destabilize the entire framework. In his view, central banks are no longer in control of outcomes, but are instead reacting to events that expose the limits of monetary intervention. Against this backdrop, the U.S. government's recent decision to classify silver as a critical mineral carries far-reaching implications. For Holter, this signals not only its growing industrial relevance, but also its potential role as a financial refuge in times of uncertainty. He stresses that precious metals, unlike fiat currencies, cannot be manufactured at will, making them indispensable in periods when trust in paper assets diminishes.
There was a financial reset in 1944, Bretton Woods, another reset in 1971 when we went off the gold standard. I guess, and this is the way, when I talk to people regarding the current situation, my first question is the U.S. government bankrupt? Are they broke? And 95% of the people will say, well, of course they are, but it doesn't matter. And then my next question would be, who is the issuer of the world's reserve currency? It's the same entity. Mm-hmm. So you have a financial world that's running on top of a foundation of paper treasuries that are issued by a bankrupt entity. The absolute need for a financial reset is in place, and there would be no BRICS if that was not the case. Mm-hmm. So the world is, more than half the world now has begun the process of moving away from dollars, moving away from U.S. treasuries as the foundation for the world's financial system. There's your reset right there. The world is resetting away from the United States. But the paper in the West has been sold by financial institutions. Yeah. They've naked shorted gold. They've naked shorted silver. That's suppressed the price. Mm-hmm. And the cash price is in China. Mm-hmm. Now, when those derivatives get blown up, you have the problem is you have balance sheets blowing up. You know, you have big brokers, huge brokers, their balance sheets blowing up. And we get right back to where we were in 2008, where because it was a financial orgy, if your trading partner has been infected, people aren't going to trade with you because you're trading with an infected party. So confidence breaks, the chain breaks, and we will end up being a cash and carry market. When I say market, I'm not talking about just gold and silver. No. I think the derivatives in oil, in wheat, in grain, all the grains, the meats, all of those markets are going to end up being cash and carry markets, because no one is going to trust uh, the counterparty risk to the other side of the trade. You've got to be self-sufficient. You got to be able to feed yourself. You've got to live. I mean, if you don't live, then well, it doesn't matter how much gold you have or silver or stocks or whatever. So you got to live, and so self-sufficiency is first. And part of self-sufficiency, you've got to be able to protect your position. And if you're in a city, if you're in a metropolitan area, how do you protect your position? You can't. You need to be rural. You need to get away from population, because those who don't have are going to look to you because you do have, and they're going to try to take it. You want to get your assets out of the system. You mentioned, obviously gold and silver. Well, gold and silver, the reason you go to gold and silver is because they are money. They're real money. And during bad times, what's the advice? Go to cash. Well, it used to be when you went to cash, it was backed by gold. That's no longer the case. Going to cash now is you're going to a commercial paper market that's debt, and debt defaults. So the reason you want gold and silver is you will have you'll have capital after this thing goes down. You'll have a lot of capital. People that are sitting on gold and silver will be considered mini banks because there's so few people. Less than 1% of the population own gold and silver. You don't want intermediaries between you and your money. I mean, if you're going to own stock, obviously, when I say obviously, this is my opinion, you want companies that make real things that are necessity. You want, basic type companies, agro companies, oil companies. You want companies that produce things that people have to use on a daily basis to survive. Now, if you're going to hold those stocks, you want to get those certificates. A year ago, it made the rounds, and it was a big, broad splash, the Great Taking. And I just want to say that the Great Taking is absolutely real. Everything that David Rogers Webb put out is footnoted. These laws are in place. The ink is dry. And when banks go under, when brokers go under, when insurance companies go under, the law says that they can take your deposits, your stocks, your cash values, and they can use that to save the company. Money in the bank, stocks, they're not yours. They're technically and legally owned by the bank or by the broker for your benefit. You are considered a subordinated creditor. And in the case of banks and brokers, you are the most subordinate creditor, meaning you're the lowest on the totem pole. You're going to get paid back last, which means you're going to lose your money first. So you want to ask your broker, you want to tell your broker, I want my certificate. And the way to do that is tell your broker to ship the securities to DRS, direct registration with the transfer agent. Once it's there, then you instruct the transfer agent to send you a stock certificate. That certificate is your proof of ownership. It's like a deed or a title. It can't be taken away from you. Now, can the company go bankrupt? Yeah, of course. Well, whatever stock you own, yeah, there's always a chance of them going bankrupt. But you don't want to own something that turns out to be a good investment, but you lost it because your broker went down and bailed you in. Bail-ins, and I mean, the FDIC has come right out and said that there's not going to be bailouts in the future. There's going to be bail-ins, which means they're going to take your money on account at banks.
Gold's recent consolidation phase should not be mistaken for weakness. Rather, it appears to be a natural pause in what could become one of the most significant bull markets in decades. After a massive rally that pushed prices to all-time highs, the metal has held steady in a tight range, signaling resilience even in the face of obstacles such as elevated bond yields and a previously surging US dollar. Traditionally, those forces would have pressured gold lower, but instead, it continued climbing, supported by record levels of central bank buying and a world growing increasingly unsettled by economic and geopolitical uncertainty. This unusual strength suggests that the foundation for the next move higher is already in place. Looking forward, the alignment of classic price drivers, softer monetary conditions, weakening confidence in fiat currencies, and ongoing demand from nations seeking security outside the dollar system could trigger a fresh wave of momentum. If these pressures intensify as expected, the coming months may see gold break decisively out of its current range, potentially setting new benchmarks and solidifying its role as the ultimate store of value in an era of shifting global order. How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.